And who are panelists, could you please turn on your video to check whether it is working right? Thank you. Good afternoon, ladies and gentlemen, or good morning for those of you in different time zones. My name is Yeonu Lee from Kim In Chang, and I'll be the secretary for today's and tomorrow's webinar. First of all, thank you all for taking your precious time to join the IFA APAC conference hosted by IFA Korea. We are greatly honored to be the host of this third IFA APAC conference of this year, followed by ones held in Hong Kong and India earlier this year. Without further ado, I'd like to begin by handing over the mic to Mr. Kyung-Bong An, President of IFA Korea, for opening remarks. Ladies and gentlemen, please welcome Mr. An.
Welcome, ladies and gentlemen. I am Kyung-Bong An, President of IFA Korea. Today marks the third of IFA APAC quarterly webinar series in 2021. We thank each and every one of you for being here with us today. Before we start, on behalf of the IFA Korea, I would like to express my sincere gratitude to all of them who generously helped making this conference a success. We are truly grateful to Yulchon LLC for providing us with the venue for filming this webinar. Special thanks go to Kyung-Gun Lee, Ted Taekyung Kim, and in particular international tax experts from several countries who are willingly taking the time to participate in each session as a moderate speaker and a panelist. We could not have made it without them. During the third IFA APAC quarterly webinar, 4 topics will be discussed in total. Today, we have 2 sessions coming up, which are respectively about recent development of beneficial ownership and anti-avoidance rules in the APAC region, and tax treatment on the transaction of virtual assets in the APAC region. As you know, the concept of beneficial ownership, which from now on I will refer to as BO, began to be used in tax treaties to prevent an abuse of tax treaties. Korea's tax treaties also include BO requirements for dividends, interest, and royalty income. Meanwhile, previous Korea Supreme Court rulings denied an application of the tax treaty as they applied the concept of real attributor of income to cases where tax treaties were used as means of tax avoidance. The distinction between a beneficial owner and real attributor was unclear. The Korea Supreme Court ruling issued at the end of 2019 confirmed that tax treaty shall be applied to tax residents only. The ruling clarified that first, it is necessary to identify if one is a beneficial owner, and if an issue of tax avoidance is still to be resolved, then we should examine if one is a real attributor of income before applying tax treaty. The 2019 Korea Amendment Tax Act introduced a new regulation that treats overseas investment organizations, namely OIBs, as a real attributor of domestic source income if certain conditions are met. For instance, if the OIB is unable to substantiate its investors. I wonder if the newly introduced regulation will resolve a lot of controversy over whether a real attributor of a domestic source income is a foreign investor or an OIB. When foreign investors invest in Korea through an OIB. Given these circumstances, it's very interesting to see recent development of beneficial ownership and anti-avoidance rules in the APEC region being discussed in this webinar. You have all been chosen to be a part of IFA APAC thanks to your passion for international taxation. During the next 2 days, we'll be learning about the various themes through our planned sessions with your active participations. Should you have any questions or comments, please send them via Zoom chat to the moderator of each session so they could get to the panel. Although this webinar goes on a limited time frame, I hope you find this webinar productive, full of opportunities for learning, an exchange of ideas, and networking. Again, we extend our heartfelt welcome to each and every one of you. Thank you very much for listening. Thank you especially to Mr. Murray Clayson and Mr. Kuntal Dave for making the congratulatory remarks. Thank you again.
Thank you, President Ahn. Thank you, President Ahn, for your generous speech. Next, let us hear a warm welcome from Mr. Murray Clayson, the President of IFA Central. Due to the time difference, he gave his speech through a pre-recorded video clip. Let us listen to his remarks.
Dear IFA friends, my greetings and best wishes to all of you attending this excellent IFA Asia Pacific region webinar organised by the IFA Korea branch, and my congratulations to the organisers for a highly topical programme with its emphasis on beneficial ownership, virtual assets, the digital economy, and important APAC international tax disputes. Let me spend just a few minutes of your time on 2 topics: a brief overview of IFA's development plans and programme, and some very brief comments on the global international tax landscape. As 2020 approached, we were all looking forward to a great series of meetings and conferences, whether at national branch or regional level, or indeed our annual flagship Global Congress with the amazing prospect of travel to Cancun last October. Of course, that was not to be, and we were obliged to embark upon a process of rethinking and redesigning our programme. It became apparent fairly quickly that an in-person Congress in Cancun would not be viable and would have to be postponed. That naturally caused a deal of inconvenience and indeed pain to our dear friends in Mexico, who after years of preparations were within months of staging their Congress. I was hugely grateful to them for their fortitude and generosity of spirit that they showed in quickly accepting the position and moving ahead positively to plan for Cancun 2022, which has now become Cancun 2023. As IFA's congresses are allocated quite a few years in advance of the event, the postponement of Cancun obviously had a ripple effect onto other future congresses, most immediately what would have been Berlin this year. At first, we hoped that the pandemic would have receded sufficiently to allow that to proceed, but that has not been the case. So Berlin is now planned for 2022, hence the further rippling of Cancun to 2023. Subsequent Congress organising branches have been less dramatically affected as their contractual and financial commitments were less advanced, but nonetheless they too have seen their plans disrupted or at least deferred. Out of all this, however, some great things have emerged. I hope that many of you will have participated in IFA's first global virtual event over several days last November. We wouldn't quite call it a congress given the lack of personal interaction, but we still managed to put on a fantastic scientific programme free of charge to IFA members, including main subjects on reconstructing the treaty network and exchange of information, the Win and Yin seminars, and our usual 3 special IFA seminars with OECD, the EU, and on recent developments in international tax, of which there have been many. While we wait for the world to conquer the virus, we will stage a second virtual event along the same lines in late November, early December this year. Most of us will have been obliged to join the video conferencing world in earnest. I confess to finding this tedious at the beginning of the pandemic, missing meetings in person, and even finding myself a little impatient with folk who instantly reached for Zoom for even a brief 2-party conversation when the phone would have done the trick. The technology did not always work as well as it might. But now we are accustomed to all of this as a new normal, and of course it has brought real benefits both to business and personally. In IFA's world, as with the world as a whole, we will have to embrace virtual proceedings as the new normal, at least to some extent. By that, I certainly don't mean the abandonment of in-person IFA events. Quite the opposite. A great part of the value and pleasure of IFA is interaction with our friends and colleagues across the world. We must and we will get back to physical congresses and other events as soon as we safely can do so. But a measure of hybridity will be with us for keeps. I can't yet predict with any accuracy the extent of that measure, but it is easy to envisage some degree of virtual delivery of our scientific programme to our members. Obviously, we have to avoid anything that will devalue membership of IFA. At the same time, we must strive to deliver great value to our members. So there is a potentially delicate balance to be struck here. I, for one, would be appalled to see IFA reduced to a virtual conference delivery platform, but that will not happen. So we will continue to look at all options, making the most of developing technological solutions, perhaps making parts of the Congress available virtually, whether during or after the event, but continuing to value member participation to an optimum extent. A related tech benefit of the last year has been the accelerated creation of our own web-based platform, now known as Studio IFA. Big thanks are due to the IFA Secretariat for their work on the establishment of this. The platform was used for the November 2020 virtual event, but can also be put to use on other occasions. Notably, we held our first IFA Conversation on International Tax Practice in May, covering a selection of universally important tax treaty and transfer pricing cases from India, Australia, the USA and Canada. Expect more to follow in this series, quite possibly something following the G20 meeting that's happening in a few days. The Studio IFA platform may also be of interest to branches and regions organising multilateral events. Also on the central IFA tech agenda is a new multi-website platform. Through this, the IFA national branches and regions can create a website using a uniform IFA template. The basic design and underlying technology is all done and available, with branches just left to create their own content. This has so far attracted considerable interest from quite a few of our branches. On the regional front, well, first let me reiterate my congratulations to the Asia Pacific region in presenting a further virtual event so hot on the heels of the web conference organised by the India branch last month, and also the webinar delivered in April under the auspices of the Hong Kong branch. We've also seen last month the first conference, virtual of course for the time being, of IFA's new North America region. And I'm delighted to be able to say that we move a little closer to completing IFA's global regional coverage by having taken the first steps towards the formation of an IFA Africa region ahead of our first ever Africa Congress, now scheduled for Cape Town in 2024. Finally, on IFA domestic matters, you should know that this year we have completed a governance review, culminating in the adoption of new articles of association and some outdated structures being replaced with something more modern. The board now has room for some regional representation, and a new supervisory board will indeed supervise and advise the board somewhat on the European corporate governance model. A new nominations committee will assume responsibility for identifying and recommending appointments to all our bodies. The development of policy has persisted everywhere. No doubt your digitisation panel will provide key insights into the current state of play in the global negotiations we've all been following. The OECD Inclusive Framework project remains very much alive and indeed has been re-energised by the change of compass in the USA, with the Biden administration dropping US objections and indeed sponsoring a global minimum rate of corporate income tax, maybe even 15%. In the meantime, competing ideas continue to circulate. For example, the recent ATAP revised proposals on Pillar 1. And of course, we now have the UN's new Article 12b. Some voices continue to express discomfort about taxation of the digital giants. In any event, latest indications from OECD are that global agreement on Nexus and minimum tax are hoped for in October. We've now seen a substantial measure of agreement within the G7, including for a global minimum tax on a country-by-country basis, and for market territories to be awarded taxing rights over at least 20% of major multinationals' profits exceeding a 10% margin, complemented by a proposal to remove all digital services taxes. Let's see what further progress emerges from the G20 meeting in a few days' time. Elsewhere in the treaty field, we have new proposals for the OECD model commentary on interest and transfer pricing. And as regards the MLI, two very recent opinion statements issued by the so-called Conference of the Parties to the MLI on entry into effect and interpretation and implementation questions. The UN has been extremely busy too, aside from Article 12b, with handbooks on taxation of extractives, dispute resolution and avoidance, and carbon taxation for developing countries, as well as updating the transfer pricing manual for developing countries and work on taxing government aid projects. The PCT has developed its toolkit on treaty negotiation. The IMF has called for windfall taxes on corporate profits, high income and wealth, and the ICAP compliance programme has been expanded. Finally, in this whistle-stop survey, I must mention the EU, who in May issued its important Communication for Business Taxation in the 21st Century. The EU plans updated energy taxation and maintains plans for a digital levy to sit alongside any global solution. It has also presented to us the acronyms DEBRA and BEFIT. DEBRA is the Debt Equity Bias Reduction Allowance, a new version of an old idea, the Allowance for Corporate Equity, designed to neutralise tax as a factor in capital structure selection. BEFIT is the new CCCTB. It is Business in Europe Framework for Income Taxation, a formulary apportionment scheme for multinational corporate tax. Alongside all of that, the European Commission will propose a directive for the implementation of Pillars 1 and 2. State aid tax cases continue to roll out with mixed results for Commission and taxpayer. So perhaps some of you will share my feeling of continued astonishment at the sheer pace of change in the world of international tax. With that, let me leave you to your conference programme, which I'm sure will be fascinating and informative. And even if a new hybrid conference format takes root, I hope that we will be able to be together soon in the same room at future events before too long.
Thank you for such a nice remarks. Next, please also welcome Mr. Kuntal Dev, Chair of the IFA APAC region, for his congratulatory words.
Good morning to my fellow IFA friends, and good evening to rest of you who are from further east. I congratulate IFA Korea branch for organizing such a wonderful webinar, and I'm thankful to them to allowing me to say a few welcome words to my friends. Now, as per the recent survey which was undertaken the aspects of reconstructing the treaty network, wherein global experts debated numerous intriguing issues concerning a further need to revamp the tax treaty framework from a principled approach. And we want to take that debate forward. The work of the inclusive framework in taxing digital economy has been one of the most lively and dynamic debate, with an attempt to achieve what is labeled as a consensus under Pillar 1. We note as recently that 130 member countries out of total 139 members of IF have endorsed the proposals of Pillar 1 and Pillar 2. Overall, the increasing role of organizations, not just OECD, but United Nations, in shaping the tax policy, along with India's loud and clear commitment to working in a multilateral framework, are indeed remarkable. The world has been a witness to the far-reaching ramifications of rapid digitalization and automation that resulted in disruption in this new normal. We all agree that technology has been a silver lining amidst the pandemic cloud. India has taken a long strides in automation and reduced human interaction in tax matters with few measures such as faceless assessment and appeal scheme, including the recently announced faceless tribunal scheme to reduce physical interface between the tax authorities and taxpayers. Other digitalization initiatives in the area of strengthening of the GST network into a robust backbone for a smooth functioning are labeled as the tax reforms of the century. Another milestone has been the introduction of the Taxpayers Charter, aimed at building trust between the taxpayer and the administration on an international collaborative front. Coming to this particular webinar, I notice that the topics which are selected for the discussion are quite interesting and are of the great practical significance, from taxation in digital era, developments in the concept of beneficial ownership, and recent tax disputes. This quite nicely summarizes the most important and significant recent developments in the world of international taxation in past 1 year. The lineup of star panelists is only going to make this event quite intellectually stimulating and worth all our time. And therefore, I'm not surprised that this webinar has received tremendous response, and I just can't wait to get them all started. It is for me quite overwhelming to see that my suggestion to APAC Regional Committee to hold quarterly webinars has been responded with webinars of such high quality standards. Thank you to all my friends at IFA Korea. And in the closing, on behalf of APAC Committee, I once again thank the organizing committee of this webinar and IFA Korea President, as well as my dear friend, Professor Kyeonjun Lee in particular. I wish that all of you enjoy and learn from the webinars, and I also look forward to welcoming you all for the next webinar that is scheduled to be hosted by Japan in next quarter, and committee meeting in the next week for APAC committee members. Thank you once again, and now I hand over proceedings back to the Secretary. Thank you.
Thank you, Mr. Dave. With that, let us begin today's sessions. In the first session, we'll discuss the recent development of beneficial ownership and anti-avoidance rules in the APAC region. Moderator to session 1 is Professor Mi-hyun Lee at Yonsei University School of Law. The following session will discuss the tax treatment on the transaction of virtual assets in the APAC region. Moderator to session 2 is Mr. Robert Browell, a tax partner at PwC Korea. For those who are participating via Zoom, you may find the presentation materials link in the Zoom chatting tool. For those who are watching this video with YouTube, you'll find the material on the right top side with download button. For those who have comments or questions, you may use the chatting tool to give comments to the panel during the sessions. So let us start now with session 1.
Thank you. Good afternoon. Welcome to session 1. I'm Mi-hyun Lee, the moderator of session 1. The theme of our session is recent development of beneficial ownership and anti-avoidance rules in the APAC region. And we have 4 distinguished panelists to discuss the issue. Before going on with presentations, I would like to introduce each panelist in the order of their presentation. Our first panelist is Mr. Aurobindo Ponia. He's an executive director with PricewaterhouseCoopers Taxation Services in Malaysia, and he has over 25 years of experience in tax consulting, research, training, and policy initiatives for tax. Our next panelist is Mr. Ikchan Zukardi. He's the managing, He's the managing tax partner with RSM Indonesia with more than 20 years experience. He has been providing tax advisory to a wide range of multinational and domestic companies, mostly in energy sectors. Our third panelist is Ms. Bijal Ajinkya. She's a senior tax and estates partner in Kaitan & Company with more than 20 years experience. She has assisted many multinational companies to structure their investment into India, as well as Indian companies to globalize in the most tax-efficient and legally compliant manner. And now, last but not least, I would like to introduce Mr. Chang Ho Jo. He's a tax partner in international tax service practice at Samil PricewaterhouseCoopers with more than 20 years of experience. He has assisted many foreign and Korean multinational companies with tax compliance, audit, defense, tax appeals, etc. We are supposed to finish by 4:30, so I would like to ask each panelist to take up to 15 minutes for his or her presentation. This will allow us around 10 minutes at the end to take questions from the floor. Now, I would like to invite Mr. Aurobindo Ponia for his presentation. Mr. Ponia, please go ahead with your presentation.
Thank you very much. Title for this panel, of course, includes beneficial ownership. I'll probably start off by saying a little bit about beneficial ownership. Malaysia, although it does have certain provisions on beneficial ownership, which is contained in the tax treaties and also in some parts of the tax legislation, beneficial ownership by itself has not been an area of priority and has not really seen a lot of development over the years. Some recent developments have actually happened on the non-tax front, which is basically the companies law. In last year, in 2020, the legislation was amended and took effect, and all companies, partnerships, sole proprietorships, and also limited liability partnerships have been required to keep a registrar of beneficial owners, wanting to know the ultimate beneficial owner of these companies. Of course, this has not just been unique to Malaysia, it's been happening globally, but Malaysia has also implemented this, and this took effect in 2020. Other than from a tax perspective itself, looking at anti-avoidance rules in Malaysia, the main rule itself can be found in its general anti-avoidance rule, the GAR provision, which is found in Section 140 of the Malaysian Income Tax Act. Now, Section 140 basically allows the tax authorities to disregard certain transactions, to vary the transaction or to adjust transactions if they believe the transaction has a direct or indirect effect of altering the incidence of tax payable or suffered, of relieving any person from any liability which has arisen or would have arisen to pay tax or make a return, evading or avoiding any liability which is imposed by the Income Tax Act, or hindering or preventing the operation of the Income Tax Act in any respect. Now, Section 140 has actually been with the Malaysian income tax law since 1967. It is not a new provision, but it's a wide catch-all provision which the tax authorities can use. The tax authorities have used this provision in certain instances. Could you go to the next slide, please?
Now, when a transaction falls within the ambit of Section 140, the tax authority may treat the income of a person as that of another person, may revise or impose a tax liability on any person, may issue an assessment or an additional assessment on a person, or rescind the repayment of tax or demand the return of any tax repaid. Now, this anti-avoidance rule is extremely wide-ranging. In applying it, the effects of the transaction, i.e. a loss of revenue to government, appears to be the determining factor. If you look at cases which have actually been used, been applied, where Section 140 has been applied, whenever there's a loss of tax revenue to the government, and the government is of the, or the tax authorities is of the view that the transaction was actually applied in a manner to reduce the tax or to evade the tax, and the transaction in a normal circumstance would have actually resulted in a tax, they tend to use Section 140. You could go to the next slide, please. Sorry, the previous slide. Thank you. All right. I've actually mentioned 3 cases here, right? These cases were actually litigated in the Malaysian courts where Section 140 was used. In the first case, SBB case. Now, in this case, there was a taxpayer who became dormant after disposing of its assets, and it had unabsorbed losses left in its accounts, tax losses. Now, after a number of years, what happened was that the taxpayer, through a series of transactions, actually ended up purchasing a profit-making enterprise. And after the profit-making enterprise was actually acquired, the assets were acquired, the shareholding in the original taxpayer was changed, and this included the person who was actually an owner of the profit-making asset which was purchased by the taxpayer. Now, with the injection of the profit-making asset into the taxpayer, they managed to actually reduce the tax liability by trying to utilize the tax losses, the original tax losses in the taxpayer. Now, the tax authority was of the view that this entire transaction was actually a sham transaction just to utilize the tax losses. So it was litigated in courts, and suffice to say that the tax authority won on this point. Now, in the second case which I mentioned here, which is Sabah Jaya, in Sabah Jaya, there was a charitable foundation, and this charitable foundation actually had a subsidiary. Now, this charitable foundation, under Malaysian tax laws, the charitable foundation itself is tax exempt. So any payments it receives, etc., would be tax exempt, and any payments made to it, would also be tax exempt or tax deductible in the hands of the payer. So when the subsidiary, instead of paying a dividend to the foundation, it actually made donations. Donations were made to the foundation, and these donations were tax exempt in the hands of the subsidiary. So the tax authority argued that the subsidiary should have made dividend payments rather than charitable donations to the foundation. They were related parties. It went all the way to court, and the court found that there was actually no intention to defraud. There was no intention to actually lower the instance of taxes, etc. And it found that the tax authority was wrong in trying to invoke Section 140. The third case itself, which is Ibraco Peremba, this was again a convoluted attempt by the taxpayers to actually lower the instance of taxes. So what happened was that the taxpayers transferred some property which they held into another subsidiary. And then from there, through a series of transactions, they again transferred, they developed the property. The property was then, the rental income on the property was captured in one of the subsidiaries. And this was then passed on through another subsidiary. And finally, the assets were disposed of. Now, in Malaysia, the disposal of assets can potentially be taxed under the capital gains tax law, which is basically the real property gains tax. Now, there was a period of time where there was an exemption provided. And what they did was that dispose of these properties during the exemption period, and the assets were finally then distributed back through a series of liquidation of subsidiaries back to the ultimate shareholders. Again, this was contested in court, and the court found in favor of the tax authorities that the entire structure which was set up was meant to actually avoid the payment of taxes. So the Malaysian, I'd say, anti-avoidance rule, the general anti-avoidance rule, is quite wide, it's quite far-fetching, and the tax authorities have used it a number of times. Taxpayers have found themselves on the wrong side of this, and ultimately their structures which they have set up has actually been found contravening Section 140 and have been struck down by the court, resulting in additional tax payable and penalties. Now, in addition to the Malaysian GAR, there are other, I would say, items which are contained in the Malaysian income tax law. These include items like transfer pricing, which I will not be covering here. It also includes things like limited deductions or disallowance of deductions on certain types of expenses, for example, entertainment expenses. And these are all, I would say, covered by the Income Tax Act itself. These are generally, I would say, quite precise or quite defined deductions which are not allowed for tax purposes. Now, other than these standard disallowance or deductions and anti-avoidance measures which are contained in the income tax law, Malaysia in recent years has been adopting a number of BEPS measures. Now, these BEPS measures, the first one being, of course, was the CBCR regime, which has been adopted by a number of countries. Malaysia introduced this from the 1st of January 2017. Now, Malaysian headquartered multinationals are basically captured by this if they have a threshold of 3 billion ringgit. So 3 billion ringgit, I think the exchange rate today is approximately about $1 is approximately about 4.15 Malaysian ringgit. Right? So Malaysian headquartered multinationals actually have to file this within 12 months of the end of the financial year if they have reached the threshold. Now, subsidiaries of foreign multinationals who are located in Malaysia, if there isn't an effective exchange of information and the subsidiary's ultimate parent entity is subject to CBCR, the tax authorities may request for a copy of the CBCR filed in the home country, provided, of course, there is no effective exchange of information. If there is an effective exchange of information, they will obtain it through that network. Other recent developments also include the introduction of a digital service tax. The digital service tax, which was introduced by Malaysia, took effect in 2020, for January 2020. So what this effectively does is that it requires foreign service providers. This includes platforms, this would include music sites, television sites, etc., who have customers in Malaysia. Now, if the payment is from a Malaysian customer, either with an address in Malaysia or paying through a Malaysian bank-issued credit card, etc., the foreign service provider is required to actually charge a service tax, which currently is about 6%, and remit an amount back to the Malaysian tax authority. I think when it was introduced, I think there were approximately about 200 to 300 foreign service providers who've actually registered themselves with the Malaysian Customs Authority and have started imposing this digital service tax. In the years, I've also seen the definition of royalties and services expanded for withholding tax purposes. This includes expansion into areas like online advertisements. Previously, there was an argument that this was not provided in Malaysia, that you're looking at software as a service, and therefore it is actually being provided outside Malaysia. But the authorities seem to be taking a more, limited view of this, and they insist on the application of the withholding tax regime to such royalties or such payments, especially to foreign, foreign software, foreign service providers. The PE definition has also been expanded. Up to recently, Malaysia did not have a PE definition in the income tax legislation. So a PE definition has been incorporated in the income tax legislation. They've also introduced earnings stripping rules. This is to ensure that there isn't, I would say, an attempt to reduce the instance of taxes by having, I would say, interest payments to related parties. And then in terms of countering harmful tax practices, Malaysia reviewed its incentives, and substance requirements were also introduced by the end of 2018. Some of the changes here included the incentive regime in Malaysia, where we found that the IP incentives were removed, and of course the nexus provision is now being introduced. So IP incentives in Malaysia now require that the nexus actually be in Malaysia. Some of you probably know that Malaysia also has, let's say, a financial services regime, which is in Labuan. And what happened with this special regime is that changes were made to comply with the BEPS rules, and therefore you would see substance requirements which have been introduced. These include substance requirements in terms of number of employees and minimum spend. And companies which actually do not meet the substance requirement, instead of being subject to the lower tax rate, would then be subject to the general tax rate of 24% if they do not meet the substance requirements. Could you move to the next slide, please? Also, what has happened is that Malaysia has adopted the MLI. The MLI was signed by Malaysia in 2018 and ratified in August 2020. They deposited the ratification documents in February 2021, and the key provisions took effect from 1st June 2021 in Malaysia. This includes the artificial avoidance of PE. In terms of Malaysia itself, in terms of the PE provision, Malaysia has actually opted for option A. So with option A being adopted, depending on its treaty partner country, so each activity of the specific activity exemption, Malaysia expects that to be applied, provided that the treaty partner countries also apply the same thing. It is also going to be adopting the anti-fragmentation rules as far as the artificial avoidance of PE is concerned. It's avoided the minimum principal purpose test as far as the prevention of treaty abuse is concerned. It's adopted the mutual agreement procedure. It's also decided to adopt the corresponding adjustment. And what it will do is that for its existing tax treaties, if the provision is not already in the treaty, it intends to ensure that this provision is actually adopted into the treaty. And finally, transparent entities. Malaysia has also decided to adopt the provision on transparent entities itself. These are some of the developments which happened in Malaysia in the recent years as far as anti-avoidance regime is concerned. And I think I will leave it at that and pass it back to you.
It's working. Thank you, Mr. Ponia, for the brief and clear explanation. Now, I would like to invite Mr. Ikchan Sukardi to speak on beneficial ownership and anti-avoidance rule in Indonesia. Mr. Sukardi, please go ahead.
Okay. Thank you, Yon, for the introduction. Good afternoon for most of us, all IFA Asia Pacific participants. And first of all, I'd like to congratulate IFA Korea for making such a great event. This afternoon, I'd like to cover the recent developments of beneficial ownership and also general anti-avoidance rules in Indonesia. The the Indonesian beneficial ownership rules was basically triggered. I mean, the development itself was triggered by the new tax treaty signed between Indonesia and the Netherlands back in the version 2004, where such interest provision, the Article 11 of the treaty, the new treaty at the time, introduced quite a unique provision in which every payments of interest made by a contracting state to another contracting state, if the tenure more than 2 years, then the withholding tax will only be payable in the country where it is resident. So meaning if any payments from Indonesia to Netherlands, payment of interest, then if the tenure is for more than 2 years, then no withholding tax at all. While under the domestic tax rule, the withholding tax supposed at the 20% rate. So the Indonesian government lose a lot of potential tax revenue at that time. So on that basis, there have been some new regulations issued basically to say negate the application of the 0% withholding tax. Before discussing in more details of that developments, we all agree that I think it is also mentioned by our IFA president that there are still a lot of tax treaties contained with beneficial ownership requirement, and I think we all also in agreement that the OECD itself, I mean, it does not specifically address how to resolve the how the definition of beneficial owner itself is very uncertain, because it is still subject to many different interpretation by the relevant, in this case, of course, source country, because they are trying to basically negate the application of the reduced or exempt treaty rates. So even worse, if you look at the requirement or the definition of beneficial ownership, those, I mean, this has not been specifically addressed in the say exchange of information or in the BEPS provision. So basically this I mean, I would expect in the very say in the coming years, there are still a lot of potential tax disputes arising from these beneficial owner requirements. So on that basis, I think it is still very relevant for us to continuously discussing this BO requirement in the respective jurisdiction. In Indonesia, the beneficial owner requirement basically, according to the income tax provision and the implementing regulation, this applies only for the interest, royalties, and dividends. And this is these requirements, the BO requirement is embedded in the specific form issued by the Director General of Taxes. We call it Form DGT, and the form is used by the income recipient enjoying the treaty benefits. So basically, if any non-resident try to access the tax treaty, so this form must be available in the hand of the payer, in this case, Indonesian payer. In the absence of a form, then the Indonesian Tax Authority will refuse the application of reduced or exempt rate. The form itself, the latest version contains 2 pages. So basically, this is, there are 7 parts of the form that you have to, the non-resident must declare or must fill out this form. So the first part is income recipient. The second part is the certification by competent authority. The third part is basically the declaration of income by the recipient. Part 4, if the recipient is individual. 5 is if the recipient is non-individual. Part 6, it's basically the beneficial owner test, and the last one is declaration. So what is important things here is that the form contains far beyond the intention itself. It is not only address the beneficial owner issue, but also extended to what we call a substantive test, or now probably we can call it principal purpose test. So the recipient is required to also meet the substance test. Can we go to the next slide? So in the following slide, so I'll cover the recent development. Can we go to the next slide, please? Sorry, the earlier slide. Yeah, as I mentioned, that the treaty, Indonesia-Netherlands Treaty was, the new version was introduced in 2004, whilst the old one, it was signed back in 1971, and it was amended and then effectively applicable 1st January 2005. And there is a circular letter issued in 2005 to clarify what is beneficial owner. So beneficial owner at the time, it was defined as the rightful owner of the income. And this is still consistent. It is mentioned as to cover dividend, interest, and royalty provision. So, but then it is interesting also to note that then in the next income tax law amendment, we also included the new or the definition of beneficial owner. So beneficial owner is defined as a person, so it can be individual or corporation entitled to enjoy the benefit. Then the law itself defines in a very detailed situation what is the say for example, if it is resident and it is the beneficial owner is in the country where it is domiciled or in the country where it is incorporated. And then there is one interesting reason at a time, interesting regulation also to say reject the application of beneficial owner under Indonesia-Netherlands Treaty by way of introducing such regulation that you cannot use Article 11 because there is no such mode of application rules in place. But then it is not, I think if you look at the other treaties, also mode of application is not available. So then it is not for a long time. There is regulation, and later on, I think there's one landmark development where in 2009, where we introduced I think for the first time, specific form as the one that I shared with you earlier, the form DGT. At that time, we had 2 types of form DGT1, it's basically for financial institution, and form DGT2, it's for non-financial institution. So this development requires that the beneficial owner it is considered as the beneficial owner if the recipient is not Indonesian resident, and then it must meet some administrative requirement, and the application of the treaty itself is not abusive. So that is why then we introduce this form. So the latest development of this beneficial owner was implemented under the regulation number 25. So basically, and this is part of the form itself, as I mentioned earlier, that the BO requirement applicable to non-resident in relation to payments of dividend, interest, and royalty, and the recipient of income, it does not act as an agent, nominee, or conduit. So it is consistent with the OECD model commentary. And the second one is the recipient has control to use or enjoy the funds. So basically, this is to confirm that the recipient has full right to the income itself. It is not merely to pass the income to other persons. And then not more than 50% of the income is used to fill any other obligation to other parties. So it is also something that you need to ensure that it is not merely a conduit structure. Then the fourth is where it is, and then the fifth one is does not have an obligation to provide for all or the income source initiative to another party. This is more or less similar to number 2 requirement, basically. So those have been used so far, and there are, I have to admit that there are a lot of tax disputes arising from this provision from the beneficial owner, and partly have been settled at the tax court, while some, majority, they are at the Supreme Court level. So I think that's all the beneficial owner part. Now I'd like to also address the rest, say the 3, 4, 5 minutes to address the general anti-avoidance rules. So Indonesian general anti-avoidance rules basically included in the income tax law, but that's in general, but the details, they are in the implementing regulation, and we are quite advanced in addressing these general anti-avoidance rules in the such details regulation. So we can divide it the anti-avoidance rules into substance over form. So basically, the Indonesian Tax Authority considers to review any transaction, what is the substance of this transaction. So basically, if the substance is basically or there's some inconsistent between the economic and the legal structure, and then they will consider that this is the avoidance. And then the second one is thin cut rules. The next one is related party definition, and the last one, tax treaty abuse. I'm not going to cover tax treaty abuse because basically those have been discussed earlier. Can we move to the next slide? So I will touch a bit on these anti-avoidance rules, the CFC rules, control foreign corporations. We do have this, and it's basically quite old regulation. It was back in, I think, 1999 when the first regulation was introduced. We listed out the jurisdiction that we consider as CFC companies. So basically, if the subsidiaries, they are from those jurisdiction, and they are considered as CFC. So the CFC itself says that any profit received or recorded by the subsidiary, regardless it is distributed or not, then if the regulations are met, then the profit is deemed to have been distributed. I mean, the dividend itself has been distributed and must be recorded in the tax return of the Indonesian parent company. The next one is the interest stripping loan. So basically, we do have this provision to avoid any situation where any investment is financed with say hybrid model. One is equity, another one is loan. And the loan itself may be recharacterized by the Indonesian tax authority if the equity has not been fully paid. The next one is the use of special purpose company. We don't have a lot of having some provision. So basically, if you if a taxpayer uses special purpose company to avoid any tax in Indonesia, for example, any capital gain tax in Indonesia, normally the Indonesian tax resident, if they are if they wanted to transfer shares to non-resident, they transfer to affiliates at book value, and later on the affiliate, which is probably established in the tax haven countries, then transfer the shares to the final buyer with the actual price and the profit recorded outside. So this kind of transaction will be caught by this provision. And the last one is international hiring out labor. So basically, this is to mitigate any situation where the Indonesian employers to structure the payment of whatever remuneration received by any person structure in Indonesia or outside Indonesia. So basically, it is subject to tax in Indonesia. I think that's all from Indonesian side subject, and I'll pass to the secretary again. Back to you.
Now, let's move on to India. Ms. Bijal Jinka, could you go ahead with your presentation, please? Mr. Jinka,
Yes.
could you go ahead, please?
Yes. Good afternoon, everyone, and thank you for attending the session. So if we could just move to the next slide, please. Yes. So looking at the beneficial ownership concept in India, I think the most important point to note here is that under Indian tax law, there is no definition of what is considered as beneficial ownership, and very few sections of the Income Tax Act do refer to beneficially holding a particular asset. So to that extent, the international meaning of beneficial ownership is most important when we apply it to tax treaties, more in the context of interest income, royalty income, as well as dividend income. India as a country has generally paid a lot of credence to international judicial decisions, as well as to the OECD model commentary and the convention surrounding the same. Though the concept of beneficial ownership has not been defined, we have had many judicial proceedings on this particular subject, and by and large, the Indian judiciary has taken the context as is understood internationally. Even though the provisions with respect to capital gains under the the Indian tax treaties enter into with many countries, especially such as Mauritius, Singapore, Cyprus, have essentially provided an Indian capital gains tax exemption. The Indian taxman has tried to apply the concept of beneficial ownership in the context of capital gains too. Somewhere it seems to be blurred as to what the difference is between beneficial ownership as well as lifting of the corporate veil or tax avoidance. Next slide, please. looking at a few judicial precedents, when we're looking at it from the perspective of interest income, there has been a recent case of the Mumbai Tribunal in the case of Bella Holdings, whereby a separate entity invested in a debenture instrument of an Indian company. Under the terms of the India-Cyprus Tax Treaty, interest paid by an Indian company to a separate resident is subjected to a lower withholding tax of 10% as opposed to the Indian withholding tax of 40%. It is with this background that a lot of foreign investment into debenture instruments has been made by the use of separate structures. Now, this investment was made at the point in time when India did not really have a legislated anti-avoidance rule, as a result of which the form of the transaction was most important and key rather than the structure of the transaction. To that extent, in this particular case, we had a Mauritius entity which had provided an interest-free loan to its separate subsidiary. And this separate subsidiary, a week after receiving that particular loan, invested into a debenture instrument of an Indian company. Important to note that under Indian tax law, any returns on a debenture is considered as interest income. However, for the purposes of exchange controls, a debenture investment is considered as an equity investment. Please move to the next slide, please. Next slide. Next slide, please.
This is next slide.
Yes, thank you. The tax authorities in this particular case essentially try to avoid giving the benefit of the India separate 10% tax rate on account of stating that the separate entity was nothing but a conduit and a passage for passing on the funds from the Mauritius entity into the Indian entity. They further went on to say that Cyprus has essentially been incorporated as a nameplate entity only with the main objective of taking the benefit of the India-Cyprus Tax Treaty. Further, there were no operations, no employees in Cyprus, and hence the treaty benefits must be denied. Next slide. The taxpayer in this particular case had a number of arguments and, of course, was successful on them. The first important point which they really raised is that when we are looking at the concept of beneficial ownership, so long as the legal ownership is with a particular entity, in this case Cyprus, and there is no back-to-back contractual arrangement to pass on the interest income to another party, the separate entity must be considered as the beneficial owner of the interest income so received. Further, the separate entity was not acting as a nominee, an agent, or a trustee of the Mauritius parent, and hence is considered as the sole owner of the interest income received. We must note here, friends, that the main point which was being raised by the taxman was essentially that because there was an absolute back-to-back funding, and to that extent, there was a treaty abuse to that extent, therefore, the separate entity is not considered the beneficial owner. However, as you would appreciate, the definition of beneficial owner essentially more connotes you essentially being entitled to the beneficial income arising out of that particular asset. Next slide, please. In this particular case, the tribunal ruled in favor of the taxpayer and essentially allowed the lower rate of withholding tax of 10% to the taxpayer. A very important point which I would like to share with you is that India as a country does not really recognize duality of ownership. So, to that extent, the legal and beneficial owner of assets is generally considered the same. Unless, of course, we are referring to situations of a nominee holding or, for that matter, an agency holding. So, even if at all we consider our trust law in India, and India being a common law country, we do have a strong common law trust in existence. Even under our trust law, it is the trustee who is considered the legal and beneficial owner of the trust assets. It would be interesting to see as to how a non-resident entity set up in the form of a trust would be eligible to a beneficial ownership article under a tax treaty from two perspectives. One is India has not really made it very clear as to whether a trust is considered as an entity eligible to treaty benefits and whether you look at the trustee's residency or that of the beneficiaries. And of course, the second most important point to note here is that under international construct, the beneficial owner of a trust asset is always considered a beneficiary, while in the Indian construct, the beneficial owner is considered a trustee. So, of course, it would be interesting to see how such an international trust would essentially ever be considered a beneficial owner of Indian assets. Next slide, please. The next ruling is with respect to a very, very interesting case and perhaps one of the largest foreign investments which India has ever had of a $16 billion. Very interesting to note here is that the taxman has tried to apply the benefits of the provisions of beneficial ownership to the provisions of capital gains article under the tax treaty. In this particular case, and this was the case of the famous private equity fund named Tiger Global, Tiger Global had invested into an entity based out of Singapore through its Mauritius subsidiary. So, here, friends, the structure which we have before us is a US parent with a Mauritius subsidiary. Mauritius subsidiary has invested into a Singapore target, and this particular Singapore target has been sold to a Luxembourg based buyer. Important to note that India has indirect transfer tax rules whereby, if at all a foreign target which is being sold has substantial value from India, then even though the sale is being undertaken offshore with respect to a foreign target, any capital gains arising on such a sale would be subject to an Indian tax. In this particular case, the Singapore entity did derive substantial value from India, as a result of which the Mauritius entity on its exit from the Singapore target was subject to tax in India. Under the terms of the India-Mauritius Tax Treaty, prior to the general anti-abuse provisions being introduced in India in the year 2017, there was a complete tax exemption for a Mauritius entity from Indian capital gains taxation. To that extent, Tiger Global Mauritius did try to take the benefits of the tax treaty, which is where it was questioned by the Indian taxman. Next slide, please. In this case, the tribunal held that the Mauritius entity is not considered the beneficial owner of the capital gains and hence would be ineligible to the capital gains tax exemption. There were certain factual points which were raised by the taxman, which were not totally, the responses to which were not totally found satisfactory by the tribunal, or for that matter, by the taxman himself. One of the important points I would state here is, as you would realize, that in most countries, when you're setting up an entity, you do need to disclose who the ultimate beneficial owner of that particular entity is. When the Mauritius entity was set up, in the KYC documents of the setup, the beneficial owner of the Mauritius vehicle was considered to be Mr. C, who was essentially the shareholder and founder of Tiger Global US. The taxman essentially held that on its own accord, the taxpayer has essentially lifted the corporate veil on beneficial ownership and has considered Mr. C himself as the beneficial owner, as a result of which this is nothing but a case of a shell company trying to take the benefits of the tax treaty. It is pretty unfortunate in this particular situation where, due to KYC as well as corporate law conditions, the beneficial owner, though which had to be lifted to the ultimate beneficial owner, had not been accepted by the taxman or by the ruling authority itself. Next slide, please. In this particular case, the taxpayer did make a lot of arguments with respect to the independent capacity with which the investment in the Singapore target was made. And to that extent, the India-Mauritius tax treaty had permitted treaty shopping even under the case of the Supreme Court. However, this has not been accepted by the taxman, and to that extent, this particular ruling is pending a judgment in appeal before the High Court. Next slide. We've not really had rulings with respect to beneficial ownership vis-a-vis dividend income, because until now, dividend income was subject to tax at the company distributing the dividends and not in the hands of shareholders. It is only recently that India has changed the tax base of dividends to be taxable. Next slide. Now we will move to the concept of general anti-abuse rules. Next slide, please. Which have essentially come into force in the year 2017. The most important and interesting part about these particular rules is that till the year 2017, India strictly followed a principle of form over substance under tax laws. And almost overnight, between March 31st, 2017 and April 1, 2017, India has changed its tax policy to incorporate anti-abuse rules, as a result of which we would now look at substance over form. Important to note that the principal purpose test has been incorporated in a number of tax treaties which have been amended under the MLI instrument. There are comprehensive transfer pricing rules in place, as well as thin capitalization rules vis-a-vis deduction of interest income. There are also consequences with respect to certain transactions which are not carried on at fair market value, and these consequences either sit in the hands of the company not acting in a manner which is as per the fair market rules, or in the hands of a buyer to shares of an Indian company. Next slide, please. Just to give an overview of the general anti-abuse provisions, the general anti-abuse provisions give a wide-ranging powers to tax authorities to treat any arrangement as an impermissible avoidance arrangement. The provisions of the general anti-abuse rules, they override tax treaty provisions. And it is very interesting to note that the India-Luxembourg tax treaty, which was signed at the point in time when India was considering the introduction of the general anti-abuse rules, has a provision mentioned that if at all any country introduces a general avoidance rule, then in that situation, those guard provisions will override the terms of the tax treaty. It is interesting to see as to how we would balance the terms of tax treaties which do not have a limitation of benefits, or for that matter, an MLI provision incorporated, in situations where the taxman seeks to apply the general avoidance rules. As I mentioned, there are two tests which need to be met in order to consider a transaction or an arrangement as an impermissible avoidance arrangement. One is a main purpose test, and the second is a tainted element test. Vis-a-vis the main purpose, it must be proved that the main purpose of the arrangement is to obtain a tax treaty benefit. And vis-a-vis the tainted element test, Any one of these four conditions must be complied with, which essentially means lacking of commercial substance, something not carried on in the ordinary course of business, if there is a direct abuse or misuse of the provisions of the Income Tax Act, as well as there are rights or obligations created which are outside of what is carried on between independent parties. Next slide, please. As a result of ratification of the MLI, a number of tax treaties entered into by India now have the provisions of the PPT incorporated. While India has adopted the simplified limitation of benefits in certain treaties, it is yet important to see as to how the provisions of the PPT would apply in situations where we have a special grandfathering provision under the India-Singapore Tax Treaty, whether the terms of the limitation of benefits article or the PPT, or for that matter, the general anti-avoidance provisions would actually override. Next slide, please.
This is the last slide.
Yes. To that extent, it is important to see as to how the general anti-abuse provisions are going to tie in with tax treaties. Till now, since the general anti-abuse rules are only effective from the 1st of April 2017, we do not have any judicial precedents on the subject. However, the taxman has already started inquiring into certain structures, and it is only a question of time before which we will have judicial proceedings. Thank you so much.
Thank you, Ms. Ajinka. We are slightly behind our schedule, but now let's go on to exploring current status in Korea. Mr. Jo, please go ahead.
It seems like I don't have much time left, but let me try to finish my presentation in time. So hello, everyone. Thanks for joining this webinar out of your busy schedule. I'm Chang-ho Jo, tax partner at PwC Korea. Today, I'd like to talk about the beneficial ownership issue from a Korean tax perspective. Next, stay on the slide. The beneficial ownership is not clearly defined under the Korean tax law. The previous one. Rather, the term is used in the tax treaties that Korea has concluded. That being a beneficial owner of a concerned income from Korea is one of the requirements to enjoy tax benefits, such as exemption of Korean taxation or some favorable reduced tax rate as stipulated under the relevant tax treaty. Therefore, it has been an area of dispute between taxpayer and tax authorities, as the concept of beneficial ownership is not clearly defined under the local tax law. Several court cases have been dealing with this concept. Next slide, please. Oh, I mean the previous one. Sorry about that. I think one of the recent court rulings rendered by the Supreme Court in late 2018 provides a meaningful guidance on this. This Supreme Court case was about a royalty from Korea to a Hungarian company, and the Supreme Court upheld the beneficial ownership of the Hungarian entity and ruled that the Hungarian entity was entitled to the benefit of the Korea-Hungary tax treaty, which is zero-rate withholding tax on the royalty income from Korea. The Supreme Court ruled that the beneficial owner is a person who receives the relevant income, has the right to use and benefit without any legal or contractual obligation to transfer it to another person. And further, it ruled that the determination of beneficial owner shall be made combining all the details and status of the business activities related to the income and the actual use and operation of the income. So, the beneficial owner shall be determined with more holistic and comprehensive review of all the surrounding facts and circumstances, not by a few facts alone. Another interesting note of this case was that the court emphasized that even if it is a beneficial owner, the tax treaty benefit may not be available if it is viewed as an abuse of the tax treaty based on substance over form rule under the domestic tax law. Then, an abuse of tax treaty based on the substance over form principle can be established if a person in the name of a property has no ability to control or manage the property, and there is another person who actually controls and manages the property. And the difference between the name and the substance arises from the purpose of avoiding taxation. Therefore, on top of establishing beneficial ownership, it is very important to make sure that the transaction shall not be viewed as an abuse of tax treaty in order to avail the tax treaty benefits. Next slide, please. When it comes to the determination of the beneficial ownership, the court ruled that it shall be determined with holistic review of the facts and circumstances, but in practice it becomes very difficult and controversial. And unfortunately, there's no clear guideline or interpretation on this. However, based on several court rulings, I think we can find some criteria that you can take into consideration when establishing beneficial ownership. Let me start with the purpose. You may need a valid business purpose to have certain legal entity or transaction at issue. This becomes more relevant when you set up an intermediary investment vehicle or an intermediary holding company in a treaty country. You may need to review when and how the entity was set up, whether the investment in Korea is a one-time event, whether there are other investments than Korea, whether tax benefit was analyzed for the decision-making. This purpose criteria has become more relevant as Korea ratified MLI. Then you have to think about the physical substance. When you set up an entity, you need to have certain number of employees, some physical office, and relevant assets. There's no safe harbor rule on how many employees you need, how big this physical office should be, and how much asset you have to deploy. However, I can say that these physical substance shall be good enough to carry out intended business of the entity, or should be good enough to manage and control the investment. With this regard, you also have to review whether and how much business expense was incurred by the entity. The legal entity may need to have some corporate governance as well to prove itself as a beneficial owner and prove that it has the capability to make its own business decision independently. These usually involves the member of board of directors, C-level officers of the entity, and how the key business decisions are made. This is to review whether there is some other person who can be claimed as substantially manage and control the income. Last but not least, we have economic substance. The beneficial owner shall have the economic rights to use, benefit, and dispose the concerned assets or income. This may involve how the fund was raised and whether the income was distributed to another person immediately, and how the income was actually used, and whether there is legal or contractual obligation to transfer this income to another person. Again, these considerations are not exhaustive list of beneficial ownership tests, and is still evolving, but I think it may provide some practical approach on the determination of beneficial ownership. Next slide, please. I'd like to introduce one of the Korean tax law that deals with the availability of the tax treaty benefits involving overseas investment vehicle, or OIV. As you may understand, when foreign investors try to invest in Korea, they oftentimes use an investment vehicle in overseas for various reasons, and this law deals with the applicability of tax treaty in that situation. Under the law, it uses the term substantive owner, which is defined as a person who actually holds ownership over the income, such as the right to dispose of domestic source income by taking legal and financial risks. But I think the substantive owner is not that much different from beneficial owner as far as the availability of treaty benefits are concerned. Next slide, please. The article stipulates 3 cases where the OIV is deemed as a substantive owner of the income. The first case is that where the OIV is liable to pay tax in the country of the resident, and the purpose of the establishment of OIV is not to unduly reduce the tax of the concerned income. The second case is where the OIV is agreed as substantive owner of the income under the relevant treaty. For these two cases, the OIV is deemed as a substantive owner of the income, and therefore it is eligible for treaty benefits under the treaty. The third case where the OIV is deemed as a substantive owner is when the OIV fails to verify the investors. In this case, OIV can be viewed as a substantive owner, but in this case, it may not enjoy treaty benefits, unlike the first and second cases. And this brings to the end of my presentation today. The beneficial ownership is one of the key areas of dispute between taxpayer and tax authorities in Korea, and it evolves as we have more court cases available. And I hope you find it useful and informative. Thank you again.
Thank you, Mr. Cho, for being very brief and clear. We are slightly behind the schedule, and we have not yet received any questions. So I think I'll just wrap up this session so that you can have some time for coffee break. Thanks for joining us.
Thank you very much, Professor Lee and the panelists, for the heated discussion and insightful thoughts. Let us take a short break before session 2, and let's see you at 4:50 again. Thank you. Welcome back to IFA APAC conference again. So in second session, we'll discuss the tax treatment on the transaction of virtual assets in the APAC region. Moderator to session 2 is Mr. Robert Broel, a tax partner at PwC Korea. Mr. Broel has been advising multinationals for over 18 years, and he's a special advisor to the Executive Committee of the British Chamber of Commerce. For those who are participating via Zoom, you may find the link of presentation materials in Zoom chatting tool. For those who are watching the conference via YouTube, you will find the material on the right top side with download button. For those who have comments or inquiries, please use Zoom chatting tool to ask them. So, let me give mic to Mr. Broel.
Hello, thank you for the introduction. And thank you, IFA, and congratulations on hosting this conference today. So hi, everyone, and welcome to this second session of today's webinar. So this session is titled The Tax Treatment on the Transaction of Virtual Assets in the APAC region. And the way we're going to approach this topic is to look at how some key countries around the Asia-Pac region tax transactions involving virtual assets. And those countries are going to be Malaysia, Australia, India, and Korea. And I'm delighted to say that we have a panel of esteemed tax experts to help us through this. And I'd like to just take a few moments just to quickly introduce each of them. So from Malaysia, we have Tanesh Khanna, who is a tax partner at Tra Tax, where he leads the international and indirect tax service lines. In his role, he services many clients that range from large Fortune 500 companies to government-linked corporations. Tanesh also serves as a key member of advisory committees and working groups formed by the Malaysian government to help frame their tax policy. From Australia, we are joined by Lauren Moses. Lauren is based in Melbourne and works at the firm Jones Day, where she represents taxpayers through the full life cycle of tax disputes on a range of issues, including international tax, transfer pricing, capital gains tax, to name just a few. She also has prior experience of working in the Australian government and the court system, which gives her a unique view of all of the perspectives of a tax dispute. From India, we have Kush Vatsaraj. Kush specializes in providing advisory services on international taxation, cross-border and domestic restructuring transactions, and Indian foreign exchange control laws, to name just a few. He has recently joined his family firm, Vatsaraj & Co., a multi-generational audit and tax practice. He writes extensively on a wide range of topics and has authored several research papers, articles, and chapters for Indian and international professional journals, news publications, and business magazines. And then from Korea, we have Michelle Kim, who is a foreign attorney at Shin & Kim's newly established international tax practice. Prior to joining Shin & Kim, she worked at Deloitte in Korea. In her role, she specializes in providing advice on all types of cross-border transactions, both from a domestic and international tax perspective. And we also have Steve Kim from the law firm Lee & Co. He has over 13 years of experience in international tax and transfer pricing, and he currently serves as a key member of Lee & Co.'s tax practice group as a foreign attorney. Steve frequently publishes transfer pricing and international tax-related articles in renowned journals and participates in many IFA-hosted events as a panelist. So that is our expert panel today. And in this session, we're going to look at the taxation of virtual assets. And so these types of assets and virtual currencies in particular are, of course, in rapid development, and existing tax rules have not typically been developed with virtual assets in mind. However, in general, government and tax policymakers still appear to be at an early stage in considering their implications. To consider some of the specific issues, the OECD did release a report last year regarding the taxation of virtual currencies. And in one of our sessions, we will highlight some of the key things that came out of that report. But the report did highlight a number of unique challenges that policymakers face with respect to crypto assets, including their lack of centralized control, valuation difficulties, hybrid characteristics, including both aspects of financial instruments and intangible assets, and the rapid evolution of the underlying technology. And at PwC, we also published an annual global crypto tax report. And in our latest edition, we highlighted that while Bitcoin was launched back in 2009, it took a further 5 years for tax authorities to begin issuing tax guidance on how digital assets should be taxed. Countries including the US and the UK took the lead back in 2014, and as the virtual asset industry has continued to evolve, we are seeing a noticeable pickup in the number of countries that have been issuing tax guidance. And our research showed that as at 2020, there are now 23 countries globally that have issued some form of guidance. Now, the term virtual assets can cover a wide range of digital assets, and in one of our sessions, we will touch on what the common types of virtual assets are. However, we are going to mainly focus on virtual currency, such as Bitcoin, to see how transactions involving these types of assets are treated and how the countries are tackling some of the key issues. And there are many issues, including how should virtual currencies be characterized for tax purposes, which will go some way towards determining how transactions involving these assets should be taxed. For instance, should virtual assets be treated as a form of property? And if so, what type of property? An intangible asset, a financial asset, or some other form of commodity? The definition is therefore important. Consideration also needs to be given to what are the potential taxable events involving virtual currencies, including a disposal of a virtual currency for consideration. For instance, is the income from the disposal treated as a capital gain, subject to capital gains tax? Or is it treated as income, subject to income-based taxes? And does that position change depending on the status of the taxpayer? For example, is the tax treatment the same if the person making the disposal is a resident or a non-resident of the country? Does it make any difference if the taxpayer performs the transaction as part of a trade or in a personal capacity? And there are also, of course, potential indirect tax consequences. What, for instance, is the indirect tax position if a taxpayer uses virtual currencies to pay for goods or services? Is such a payment seen as a taxable event? Is it seen as a barter transaction? And once you've determined how such income may be treated, it is then necessary to understand the compliance obligations that taxpayers have in the country in terms of reporting the transactions and paying any tax due. And this is by no means a comprehensive list of the issues. There are many other issues as well. And so I hope you will agree that there are some really very interesting issues here. And so I suggest that we get into it and start our tour around Asia to see how other countries are tackling these issues. So let's first start in Malaysia. So let's go to Tanesh in Kuala Lumpur. Over to you, Tanesh.
Thank you, Robert. So first of all, I don't have answers for all the questions that you just raised. Neither does OECD. So what I'm going to do now is first going to build on to those questions based on what OECD has just published a few months ago, and then come back to the Malaysian position. If I can have the slide, please. Okay, thank you. So this slide deck represents an overview of common types of crypto assets. Of course, what we are going to focus on a lot naturally is the first type, which is the virtual currencies. The most famous one being the Bitcoin, and as well as there are other examples like Litecoin and Ether and whatnot. But just for record, we also have other crypto assets such as security tokens, as well as utility tokens. In the interest of time, we won't focus so much on those two aspects, but pretty much on the payment token. I think the biggest question on the payment tokens is whether or not it is an actual currency, or rather, to introduce a jargon to that, is whether or not it's a fiat currency. Fiat currency simply means it's whether it's a legal tender or not. And really, there's no consensus about this. what we see happening as a general trend is that the Securities Exchange and the central bank have different point of views, and it does take quite a bit of time for them to align their point of views on this particular question of whether virtual currency is a fiat currency or put simply a legal tender or not. And in many cases, there's very little efforts to subsequently synchronize such position with the tax authorities. And Malaysia is no exception to that. Perhaps to address this issue systematically, I will first start with the common considerations put forward by OECD. If I can have the next slide, please. Okay, so these are the considerations that OECD put forward in taxing digital currencies. To begin with, are virtual currencies actual currency, or what we call as a fiat currency? Many countries, including Malaysia, have taken the position that virtual currencies are not fiat currency or not actual currencies, put it this way. But that position, at least in Malaysia, has very little clarity whether that position has a bearing on tax treatment or whether the tax treatment would be completely independent. Take, for example, the second consideration, right? Creation of virtual currency, the taxing event that's attached to creation of virtual currency, right? As most of us know, in many cases, virtual currencies are created by mining activity. That is not the only way to create a virtual currency. There are other ways to do it, but the common way, however, still remains as mining, or what we call as solving complex mathematical problem. So that is, if such mining activity is performed within the soil of Malaysia, then that tends to be a business income. Then question arises, at what point do you tax that activity? Is it at the point where you successfully solve the mathematical problem and hence create the currency, then you're rewarded with the currency? Or is it at the point where you dispose the currency? And that pretty much depends on whether you regard the currency itself as an actual currency or not. Because if you take if you take the view that the virtual currency is an actual currency, then the taxing point comes in at the point where you create the currency and you're rewarded with the currency. And however, you can't pay taxes with virtual currencies in Malaysia as well as in most part of the world. So you would have to eventually come up with some liquid assets to settle the tax liability there. But if you take the view that these virtual currencies are not fiat currencies or legal tenders, then the next question arises whether there should be it should be regarded as a non-monetary consideration that you have earned for your business activity, or it should be just regarded as that the consideration is not earned yet until the currency is disposed. So as with many countries, Malaysia doesn't have a clear position of the taxing point of the virtual currencies, although creation of virtual currencies itself is pretty much understood to be a taxable event. The taxing point itself is not very clear. Disposal of virtual currency, whether that's taxable or not, that's a very important question. Perhaps that's probably the most important question for many people in this webinar, simply because when you're dealing with the traders who is involved in the virtual currencies only to the extent of buy-sell transactions, right? So again, is that capital or revenue? Malaysia, we apply badges of trade. So we look at the factors like the frequency that you do it, the length of ownership, and blah, blah, blah. But what I can say is, from a very practical viewpoint, it is difficult to defend a virtual currency as a capital transaction as compared to other investments, simply because the way it appreciates, or rather the perceived speculative nature of these currencies. Again, I'm not saying it's impossible, but it's just that practically it gets a bit more, you need to be a bit more careful when you try to defend it as capital transaction. Disposal, other than for consideration, that's where we have an exchange of virtual currency with other assets. Indirect tax treatment, valuation basis, taxation of hard forks. Hard forks simply mean, put it this way, where we have a spin-off currency that builds on an existing currency, or rather an enhanced version where the transaction node is changed, right? OECD also recommends that when we talk about taxing digital currencies, we have disposal, we have guidance on to deal with disposal of virtual currency by way of gift as well as inheritance, and loss or theft, as well as anti-money laundering consideration. So that's a fairly long list of consideration to add on to to the questions that Robert just posed. To really look at how many of it as Malaysia answered is less than 3, right? We have guidance on very few of these matters. So the Malaysia specific comments on the next slide. So Malaysia perspective, Central Bank and Security Exchange have issued guidance on this. The central bank guidance was issued in 2018, pretty much centered around anti-money laundering activities and whatnot. Whereas the Security Exchange guidance was issued in late 2019. And at the onset, there was a bit of confusion among public whether this Security Exchange guidance is a blessing to take it as a legal tender, and then the Security Exchange had subsequently had to come out and say, nope, we're not blessing it as a legal tender. Our position remains that this is not a legal tender. It is not a fiat currency, but nevertheless, we want to cater the IEO, initial exchange offering, in the securities market, and that's why we need to regulate it by way of this this guideline. I believe that later on, many of my panel members could also share similar experience on this. On the tax front, real property gains tax. So Malaysia doesn't have a comprehensive capital gains tax system. We only have a real property gain tax that imposes taxation on gains or profit arising from sale of real property. Now, one might think that is so obscurely related to cryptocurrency, but that's not the case. We actually had an actual case where a land sale transaction was concluded in a very conventional way with the SPA and sale and purchase agreement and registered with the land office and everything. But the consideration was determined by way of Bitcoin rather than a ringgit denominated consideration. And the taxpayer tried to argue the case by saying that, oh, this is cryptocurrency and the gain has not been realized, blah, blah, blah. And as you could guess, obviously that failed, right? That failed the script, simply because the real property gains tax system had mechanism within the domestic law to capture non-monetary considerations for disposal, and that was invoked very rightfully. The next thing that we have is stamp duty. So stamp duty is a tax on instruments. So I could talk about this from two perspectives. One is, a similar sale and purchase transaction where there is an instrument, but the consideration is denominated by way of a virtual asset or a cryptocurrency rather than a fiat currency. In that case, it appears quite clear that the stamp duty would continue to apply. You just have to convert to the ringgit equivalent. But there's also questions about whether transactions in the cryptocurrency itself is subject to stamp duty or not. Again, there is no published guidance on this. Many tend to take the view as long as there's no instrument that governs this and is a commodity transaction, therefore there's no stamp duty on it. As far as income tax is concerned, I think I've just commented about the trading and creation. Trading could be capital, could be income in nature, depending on the badges of trade. There's no specific regulation, but practically there's a tendency to regard cryptocurrency-driven transaction as trading rather than capital. Also because Malaysia doesn't have a capital gain tax system. Creation of a virtual asset by way of mining or whatnot is obviously taxable, but then there are questions about at which point it becomes taxable. Is it when you earn the currency or when you realize it? Malaysia doesn't have, on the indirect tax front, Malaysia doesn't have a comprehensive GST or VAT system, but instead we have a service tax regime that imposes service tax only on a number of very limited, well, some say limited, but some say arguably broad, but the point is not a very broad-based consumption tax. So issues around cryptocurrency and service tax is pretty limited at the moment. So that would be my summary for Malaysia. Over to you, Robert.
Thank you, Tanesh. That's very, very interesting. And so it seems like there's limited guidance so far issued by the Malaysian authorities regarding the taxation of virtual assets. So let's see what the position is in Australia. So let's go over to Melbourne, where we can join Lauren. So Lauren, can you hear me? Over to you.
Thanks, Robert. So it seems like Bitcoin has been the test case for virtual assets in general, and the case is the same in Australia. So going back as far as 2014, the Australian Tax Authority has considered how Bitcoin in particular should be considered from an Australian perspective, and landed on the view that it's considered to be property or a CGT asset for the purpose of our tax regime. They did that really in reliance on a principle that was established by a High Court case here in the 90s that said that property refers not to a thing necessarily, but the description of a legal relationship with a thing, and specifically the degree of power that's recognised in law as permissibly exercised over that thing. So on that basis, the ATO concluded that the particular rights that exist in relation to a cryptocurrency or Bitcoin were proprietary rights, and that it was a piece of property legislative changes at all. It's interesting to hear the Malaysian perspective because it's quite different here. Here in most cases, I've got it the other way around on the slide, but in most cases, when you've got your standard trader who's buying and selling Bitcoin or any other cryptocurrency or virtual asset, ordinarily, in most cases, that will be on capital account for our purposes. So it will be considered to be a capital asset, with the result that the gain when they sell the asset will be taxable under our capital gains tax rules. And if it's an individual who's held the cryptocurrency over that period for at least 12 months or more, then they effectively only pay tax on 50% of the gain. There's a concession available, provided they're an Australian tax resident. There are other possible tax treatments. They're less common in practice, but it is possible to be found to be carrying on a business that involves transacting with cryptocurrency. As Tanesh said, it really depends. There's established rules about when you're carrying on a business that look at the particular way that things are being conducted. But if it's found that you are engaging in a business, this is distinct from using cryptocurrency in your business, but you're actually engaging in a business of either mining or trading cryptocurrency, then the cryptocurrency itself is considered trading stock, with the result that when you buy it, it's deductible, or when you sell it, it's ordinary income. There are some cases where an isolated transaction in cryptocurrency might be ordinary income as well, but that would be a pretty rare occurrence. The third category, where the bar is pretty high, but the ATO do recognise that cryptocurrency can be a personal use asset. As you'd expect, the bar is set very high. So their view is that in order to be considered a personal use asset and then not subject to tax at all, it's really where you've bought it for a very short period of time to acquire goods for personal use, essentially. And you have to have acquired the goods directly with the cryptocurrency, as opposed to first converting it, for example, to Australian dollars or any other currency, or having to use some other sort of third-party payment system. So as you can imagine, so capital is in most cases the most common, but the line sometimes between those three sort of different main ways that it can be treated is not always as clear in practice. So if we can just move on to the next slide, I thought it might be interesting to focus a little bit on some of the challenges, the unique challenges that are faced by the tax authorities, and particularly in the context of the ATO. But I think it's probably quite universal, and some of the ways that they've sought to address those. So I found a number of statistics in terms of how many cryptocurrencies are currently being traded, but the most reliable one said it was around 5,000. Needless to say, it's a lot. It's a very high number, and depending on who you ask, it seems that the most common ones at the moment are Bitcoin, Ethereum, and Tether. I have to admit to not having traded any of them myself, but obviously it's all big news. One of the reasons this area has had so much focus from the OECD, governments, and tax authority is just the sheer size of some of the gains involved. So as far as bubbles go, apparently the most famous bubble of all time is the Dutch tulip bubble that gripped Holland in the 1630s, where tulip prices soared 20-fold during a 4-month period before plunging back to earth shortly after. So to take Bitcoin as an example, although its rise hasn't been quite as shocking as the tulip bubble of the 1630s, it's not really too far off. So just to take as an example, a single Bitcoin was valued at 8 cents in 2010, and today was trading at $34,700 US. So it's really quite phenomenal. If you'd purchased, as you can see on the slide, if you'd purchased $1,000 worth of Bitcoin 5 years ago in 2016, it'd be worth approximately $140,000 today. And last year alone, Bitcoin doubled in value. But before you all run off to quit your jobs and invest in Bitcoin instead, it hasn't all been gains over the years. In its sort of 12-year history, it's also had a few spectacular crashes or extended periods where it's really just gone sideways. And obviously there's the general concern with any bubble, but it's really only a matter of time, but time will tell. And the same goes for the other cryptocurrencies as well. So really what that means is there are potentially significant gains that the revenue authorities are going to be interested in taxing one way or another. Another interesting sort of tension that arises in this area is between compliance and anonymity. So those who sort of philosophically believe in the value of cryptocurrencies as a decentralized and unregulated method of paying for things and transacting feel that anonymity is an important part of that, and that governments really shouldn't be using their powers to, for example, to collect information or compel people or organizations to provide them with information. They shouldn't be using those to take away from that benefit of anonymity. As you can imagine, the revenue authorities and the ATO are probably not particularly persuaded by that argument, given the potential for tax evasion that arises. If we can just go on to the next slide. In terms of what they're doing to address this, I mean, as technology has advanced and methods of avoiding tax have become more sophisticated, so too the revenue authorities have had to really upskill to keep pace. So in early March this year, the IRS announced the aptly named Operation Hidden Treasure, which is a partnership between the US Civil Office of Fraud Enforcement and the Criminal Investigation Unit of the IRS, where they're using their existing skills in that area, but also training IRS agents to look at blockchains to identify some of the signatures of tax evasion amongst cryptocurrency users. So that project's being housed within the IRS, but they're working very closely together with their counterparts at the ATO and also within the EU, in some part through the Joint Chiefs of Global Tax Enforcement Group, or the J5. And all of these organizations have really had to, through a combination of employing, IT professionals or even former hackers in some cases. I found some reports to create a workforce and train their people to be able to identify these things. In the case of the ATO, they also routinely collect data from designated service providers, which are essentially the entities that provide digital exchange services in relation to digital currencies, which at least in Australia are required to be registered. So that's not too difficult a task. And they collect that data routinely and then use that to data match and identify, well, there's really two purposes. In some cases, they identify people who are just trading cryptocurrency so they can, in the friendliest sense, communicate with them what their obligations might be, because this is a process of education in many ways, or also to expose those who may not be compliant. So I think we can expect ongoing collaboration between governments and tax authorities in this space in the APAC region and globally as they become more and more sophisticated in their methods. So watch this space.
Thank you, Lauren. I mean, it's very interesting. It sounds like the Australian tax authorities are a bit more advanced and working very closely with other authorities kind of globally and in the region as well. So that's very interesting. So thank you, Lauren. Thank you for that. That's very, very insightful. So we've looked at Malaysia and we've looked at Australia. And so let's turn our attention now to India. So Kush is in Mumbai and is going to kind of enlighten us on how the Indian authorities are looking at virtual assets. So Kush, over to you.
Thank you, Robert. Can I just get the slide? Yeah, the next slide. Thank you. So from an Indian perspective, firstly, it's very important to know that India was till 2018 had banned cryptocurrencies through its central bank, and basically because of fears of terror financing and money laundering concerns. However, the Supreme Court struck down this ban in 2020 by saying that it interfered with the constitutional right to business and commerce. So, and said that instead of banning cryptocurrency outright, it should be regulated with proper rules and regulations. So today we are at a situation where the Indian government does not consider cryptocurrencies to be legal tender, and does not allow direct payments in cryptocurrencies, but has tolerated or has allowed transactions in cryptocurrencies to continue. It's likely that they will be considering a bill called the Cryptocurrency Regulation of Official Digital Currency Bill in the next parliamentary session, which is likely to begin this month itself. It's interesting to know that the central bank, the Reserve Bank of India, has stated that it intends to probably come up with its own official digital currency, which is also reflected in the name which is given to the bill, which is going to be considered by the government. So from a definition perspective, it's important from three perspectives. One, from an income tax perspective for direct taxation, also for levying the indirect tax, which is the goods and services tax. And India also has securities transaction tax and a commodities transaction tax that applies to transactions in securities and commodities. So the definition or the classification of virtual assets, especially cryptocurrencies, is relevant from this perspective. Next slide, please. From an income tax perspective, there has been no formal communication or no official guidance, but there is one principle which is known in India, is that whether the income itself is legal or illegal, legitimate or illegitimate, income tax liability has to be discharged. So even there are cases where income from smuggling has been subjected to income tax, irrespective of what the legality was. So even when there was a ban on cryptocurrencies, the income from then arising from cryptocurrencies was subject to tax and is subject to tax even today. It's very likely that given the definition of the term capital asset under the Indian law, virtual assets would be classified as capital assets. However, there is an exclusion that if such assets, which are capital assets, but they are held as stock in trade or as a business asset, then they would not be considered a capital asset, but a business asset. Since India does not consider cryptocurrencies to be legal tender or currencies, it would not fall out of the definition of capital asset. However, if in the future it becomes a legal tender or a recognized currency, then maybe this treatment could change. Also, from a perspective of cross-border taxation, determination of the situs of the capital asset of the cryptocurrency would be important. Because from a non-resident's perspective, if the currency is deemed to be situated in India, it would be the income arising from that would be subject to tax in India. But given that cryptocurrencies are likely to be considered intangible assets, it's unlikely that a non-resident's cryptocurrency holdings would be deemed to have their location in India. Next slide, please. From an indirect tax perspective, the definition of goods for the purpose of GST, which is India's indirect tax legislation, is wide enough to cover virtual assets as goods, but there is no specific classification, or we follow the HSN code as well in India. So there is no specific classification which has been given to cryptocurrencies, which would make it difficult to tax them as goods under the indirect tax laws. Similarly, for services, the transaction in cryptocurrencies itself would not be a service, but services around transactions on cryptocurrencies would be considered services. There are no specific service accounting code, which is the service parallel to HSN codes for goods. So there's no specific service accounting code which has been given to virtual asset related transactions. But we recently had a Minister of State for Finance clarify that although there is no specific code, that only means that there is no, there is no monitoring or there is no transaction by transaction record being kept of how many transactions and what kind of transactions are being undertaken for cryptocurrencies. but the indirect tax is nonetheless to be levied under the residual category of services. So for crypto exchanges or wallets which are charging consideration from users, they would be having to charge an indirect tax on their fees, but not directly on the transaction fees. As I said, that if in the future the currency nomenclature is given to cryptocurrencies, or if they're considered a security, and then they would be subject not to GST but to the securities transaction tax or the commodities transaction tax, which is prevalent in India. Next slide. So from the definition perspective being considered from actually taxing the transactions. So firstly, mining of cryptocurrencies, this being a self-generated asset, there is very clear guidance in India that from the Supreme Court itself, that where there is no mechanism to determine the cost of a self-generated asset, the transaction of generating that asset itself cannot be subject to tax, because the mechanism to compute the capital gains would fail. However, if you go to the next step of the transaction, which would be buying and selling virtual assets or cryptocurrencies, that would be the point at which tax would be levied in India. And I think similarly to Australia, although Australia has probably has official guidance, in India it's what has been the inference and the interpretation of experts, that the classification of gains on cryptocurrency transactions would be either capital gains or business income, depending on whether they are held as investments or as capital or as stock in trade. Australia has I think has a 12-month holding period for being considered long-term and short-term. India would have a 36-month period, so it's highly unlikely that someone has long-term capital gains from crypto. And in the event someone takes an argument that cryptocurrencies cannot be considered capital assets, but they're financial assets, and they're neither held as business income or as business assets, they're just held as a personal asset. India also has a residual head of income called income from other sources, and it's very likely that even if someone argues that income from crypto cannot be taxed as capital gains or as business income, it will definitely be taxed as this residual other income. Coming to payments using cryptocurrencies, although this is not really a tax consideration, from an Indian perspective, from a cross-border perspective as well, the Indian exchange control regulations do not permit Indians to pay for import of services or import of goods using cryptocurrencies, nor do they permit them to accept consideration or payment for export of goods or export of services, because Indians are only allowed to transact in foreign currency or receive consideration or pay consideration through the regular banking channels. So any transaction where goods and services are exchanged for cryptocurrencies would be considered a barter transaction, at least from an income tax perspective. And there would be really no difference in the tax treatment, whether it's a payment using cryptocurrency or a direct transaction in the cryptocurrency itself. The other type of transaction, not directly relating to the transaction of the cryptocurrency itself, but the transactions around cryptocurrencies. These are especially important to India from the perspective of cross-border transactions, where facilitating of trading or buying and selling are done on foreign exchanges or through foreign service providers. And there is India's new nexus law called the Significant Economic Presence, or SEP, will impact such transactions. Can I have the next slide, please? So India's new nexus rule, which has been implemented recently pursuant to BEPS Action Plan 1, it basically is the new nexus rule, which is similar to the PE concept in tax treaties. It provides that if a non-resident has an SEP in India, that would be akin to a PE in India, and any income which is attributable to such SEP would be taxable in India. So for example, if we have foreign exchanges which are allowing transactions in cryptocurrencies to be done, and they have, say, more than 300,000 Indian users, or the transactions with Indian people exceeds 20 million Indian rupees, which is roughly 270,000 US dollars, then they would be considered to have an SEP in India. And any income which that exchange or that platform is earning would become subject to tax in India under this new nexus rule. This may not directly impact every exchange in every country, but mainly those exchanges or those non-residents who are sitting in non-treaty countries or in case where the treaty benefit is denied under the PPT, or in the Indian general anti-avoidance rules. So those kind of transactions, especially facilitating virtual asset transactions, marketplaces, wallets, etc., those incomes could become subject to tax in India. Next slide, please. From the indirect tax perspective, because today the crypto assets are not considered to be goods, there is no GST which is levied directly on transactions in cryptocurrencies domestically or cross-border. However, as I said, that the services relating to transactions in crypto assets on exchanges or in wallets, where a consideration or a fee is charged by the platform itself, that is considered to be a service, and GST is levied on that. From a cross-border perspective, non-residents don't really have much to worry about, because India, the mechanism in India is a reverse charge mechanism, where any import of services or import of goods, if at all, virtual assets are considered to be goods or services directly, any import of such virtual assets would be taxed in the hands of the resident individual rather than the non-resident on a reverse charge basis. And export transactions generally are considered to be zero rated. However, that only works if the consideration for that is received in foreign currency. And as I said, that because of the Indian foreign exchange regulations, that really would not be a transaction which we would see in India. Also, from a perspective of Indians using foreign exchanges or foreign intermediaries, because these intermediaries would be located outside India, they would not be subject to GST in India, because the Indian GST rules state that where an intermediary is located outside India, the place of supply of services would be deemed to be outside India, and therefore outside the jurisdiction of Indian GST. As I already stated, the barter transactions would not really be similar to income tax. There would be no difference in their treatment if they were done domestically. If I were to say go and use my, I don't have any cryptocurrency, but if I had, then I would go and try and purchase a car with my with Bitcoin. It would be considered a sale of Bitcoin as well as a purchase of a car. So those two transactions would be looked at separately, not as a composite transaction. And coming to the commodity transaction tax or the securities transaction tax, this would possibly one future levy which could be there. However, this would only apply if the crypto exchanges are considered to be a recognized exchange in India by India's securities regulator, which is the SEBI. So until that classification comes in, it's unlikely that these taxes would apply. Next slide, please. From a disclosure perspective, recently in April itself, the Indian Ministry of Corporate Affairs came out with a new notification stating that all Indian companies will be required to disclose their crypto holdings on their balance sheets. So they would have to disclose the profit or loss incurred on crypto transactions and the amount of crypto which they hold. And also, interestingly, they would have to disclose the deposits or advances they've received for the purpose of trading in or investing in cryptocurrencies. From an income tax perspective, certain individuals having income above a certain threshold, and all businesses and companies are required to disclose their assets and liabilities in their return of income. And these crypto assets as well would have to be disclosed under this. So India is probably moving towards regulation. The existing rules are applying, and there's no real reason to think that these transactions would not be subject to tax. But yes, we should probably have guidance in the near future regarding the exact and the final classification from a tax perspective. So I'll wrap up here and hand it back to Robert. Thank you.
Thank you, Kush. That's really interesting to see how the Indian authorities are taxing these types of transactions, even though the authorities said that the cryptocurrency was illegal in India. So very insightful. Thank you, Kush. So next on our tour of Asia is actually Korea. So we're going to hand over to Michelle. So Michelle, over to you.
Thank you, Robert. Good afternoon to everyone in the audience. For the Korea chapter, it's going to be divided into two presenters, and I will be the first presenter covering the relevant laws regarding virtual assets, and my colleague Steve is going to dive a little bit deeper into some of the issues that he has seen based on his experience. To give a brief background, the taxation of virtual assets was part of the 2020 tax reforms announced by Korea's Ministry of Economy and Finance in July of last year. However, unlike a majority of the tax amendments that typically became effective January of this year, this particular amendment was initially to be effective October of this year, and then it's been further pushed back to January of next year, 2022. In terms of the current virtual asset market in Korea, I thought it would be just to lay a foundation as to where we are coming from. I thought it'd be worthwhile just to briefly discuss some of the media coverage regarding virtual assets in Korea for the audience. Generally, virtual assets, and in particular cryptocurrencies, are very popular amongst Koreans in their 20s and 30s. As Lauren mentioned in her presentation, it has actually been reported that individuals are quitting their daytime jobs as their profits from managing crypto investments have higher returns than their wages. It was also reported in April 15th that the trading volume of cryptocurrencies more than doubled the amount traded on the Kospi market. However, due to the high-risk nature of the investments and the connection to illegal financial practices such as money laundering, Korea has enforced mandatory reporting and compliance regulations to traders and also the market. So to jump into what is the definition of a virtual asset, it is defined in the Act on Reporting and Using Specified Financial Transaction Information, and it states that a virtual asset is an electronic certificate that can be traded or transferred electronically as having economic value. Now, under this broad definition, it lists out exclusions that are not considered to be virtual assets under the relevant law. Some obvious examples are electronically registered shares or stocks, electronic notes, bill of lading, tangible and intangible assets acquired through the use of games. Just as a side note, as my colleagues have touched upon, and Steve will as well, under the K-IFRS, virtual asset is actually defined as inventory if it is held for the sale in the ordinary course of business, and otherwise it is classified as intangible asset. Now that we have defined what a virtual asset is, going on to the next slide, we're going to look at how virtual assets are taxed. I've organized it through a chart based on whether it's a corporation or individual and whether the investor is domestic or foreign. So for domestic corporations, the income or gains from virtual assets, it will be included in the taxable income. It'll be taxed at the applicable tax bracket that applies to the domestic corp. For resident individuals, the income or gain is categorized as other income and it's taxed at 20%, which goes up to 22% if you include the local income tax. However, if the total annual income from the virtual asset is less than 2.5 million Korean won, as included in the table below under exclusion, it will not be taxed. So for instance, if an individual sells Bitcoins and earns 4 million in gains, the 2.5 million will be excluded and only 1.5 million of the gain will be subject to the 22% tax. For foreign corporations and individuals, the income itself in Korea is categorized as Korean sourced other income. Based on the legislation, it states that such income may be withheld at 22% of the gain amount or 11% of the sale proceeds, whichever is lower. And please bear in mind that these figures are all inclusive of local income tax. Generally, such other income may be exempt under the applicable tax treaty, provided that the exemption form for other income is submitted. However, if in the instance that such income is treated as capital gains, or if the applicable tax treaty is silent on the issue, whether this is the right treatment or categorization is something that is up for debate, and that will be further discussed by my colleague Steve in his presentation. Also, next onto the tax base, this seems fairly straightforward, but the tax base of the virtual asset income is equal to the transfer consideration or market price, and you subtract the acquisition price and incidental expenses. Incidental expenses include transaction fees, drafting filing fees, and in some instances, court fees. I guess one point that I wanted to mention here is that for acquisitions of virtual assets on the cryptocurrency exchange, After the implementation of the amendment, the FMV, the fair market value of the virtual asset, will be the greater of these two values. The first being the FMV as of January 1st, 2022, or the acquisition price that can be evidenced through documentation. So for instance, for the Bitcoin you bought in 2001, the FMV will either be the FMV on January 1st of 2022, or the acquisition price that you have evidence, whichever price is higher of the two. And the purpose for this is so that unrealized gains accrued before the enactment date is actually not subject to tax. On to the next slide. In terms of tax filing obligations, I've also organized it in the same manner. For Korean corporations, the income of the virtual assets will be included in their taxable income, and it will be subject to tax filing and payment during their filing period. For Korean residents, payments are due once a year in May, and this is a separate filing from that of the individual income tax return and should be filed separate. For example, like income tax, like capital gains or severance income. And essentially, there would be no withholding tax levied, but the individual will need to report the amount of gains and losses at the end of each year. For foreign individuals and companies, the virtual asset operator or virtual asset service provider is actually obligated to withhold tax and pay monthly to the relevant authority by the 10th of the following month. The withholding tax is levied when the money is actually transferred out of the account. Also, Korean residents and corporations with a total of 500 million Korean won or more in overseas cryptocurrency accounts as of the end of any month in the year will now be required to report the overseas account starting in June 2023. This is essentially because cryptocurrency accounts have now been included into the definition of foreign financial accounts. In terms of the penalty to arise from the failure to file such taxes, they're similar as any other return in that for non-reporting tax filings, there's a 20% penalty on the amount not reported. And for underreporting, there's a 10% penalty for the underreported amount. For amounts that are greater than 500 million, that should say million Korean won, the penalty may be criminal. And on to the next slide regarding indirect taxation, whether the virtual asset would be seen as a supply of goods or service. As mentioned, there's no clear provision as of now, but the Ministry of Economy and Finance in March of this year actually published an interpretation that indicated that the supply of a virtual asset is not regarded as the supply of goods. So essentially, VAT would not be levied on the transaction of cryptocurrency according to this interpretation. And without further ado, actually that concludes my portion of introducing the taxation of virtual assets in Korea. And my colleague Steve, as I mentioned, is going to talk about some of the issues that he's seen based on his experience. Back to you, Robert.
Thank you, Michelle. I mean, it sounds it seems really interesting that non-residents realizing gains in Korea, actually the onus is on the virtual asset operators in Korea. And so the crypto exchanges themselves are going to have to do the filing and pay the taxes in respect of any gains that are realized by non-residents going forwards after the 1st of January 2022, as you mentioned. So Michelle, just one question on that. Do you know what sort of kind of reporting obligation the crypto exchanges have? I mean, what sort of information are they going to have to disclose going forwards, if you know?
That's a great question, Robert. Virtual asset operators are actually going to be required to submit a virtual asset transaction statement for each of the traders. And this has to indicate information such as their name, registration ID, bank account information used to transfer the funds. Also, information regarding the counterparty conducting the transaction also needs to be provided. And additionally, detailed information regarding the type of virtual asset, the date, the consideration paid, and also the tax base is all going to need to be disclosed on the statement. And such reporting is going to be due on a quarterly and annual basis. And like you mentioned, is going to apply starting January 1st, 2022.
Great, thank you, Michelle. So there's quite a lot of information that the crypto exchanges are going to have to maintain and keep going forwards in order to meet those obligations. That's really interesting. Okay, great. So thanks, Michelle. So as Michelle said, we're going to now hand over to Steve from Lee & Co, who's going to look at more of the international kind of aspects regarding transactions involving virtual assets from a Korean perspective. So Steve, over to you.
Hi, thank you, Robert. Thanks to all panelists, Dennis, Lauren, Kush, and Michelle for providing very interesting development in your respective jurisdictions. Now, I'll take it from here and shift gear a bit to talk about the tax treaty aspect of the cross-border transaction involving virtual asset in Korea. Basically, I envisage that there will be some ambiguity in the application of the tax treaty on the cross-border transaction involving the virtual asset, due partly to the ambiguity in the legal classification of the virtual asset. And I would like to share this issue with all of you to gauge the risk and look to see how this issue will pan out in the days to come. So before getting into the details of my content, let me just start with a brief background on why I chose this particular topic. I've been advising client for many years, and recently I received a quite sizable question from the client in other part of the APAC region in a lead up to the taxation of the virtual asset in Korea that Michelle just laid out earlier. So perhaps these questions cannot be segregated from the influx of the virtual asset in South Korea for past couple of years. There is what is referred to as a kimchi premium, which is basically price gap in crypto asset price between the South Korean exchanges and those of the foreign exchanges. This prompted many foreign investors to arbitrage such differences in price, and the gap used to soar up to 30 to 50% difference, but not anymore, and it currently hovers around less than 10%. There are many explanations for this phenomenon, but the main theory that gets the most support from the pundit is that it is attributed to the lack of other high return investment opportunity in South Korea, especially amongst the younger generations, and also partly attributed to the country's interest in technologies and online gambling. On to the next slide. So now with this background, let's get to the details of my contents. For your better understanding, let's take a look at one simple hypo case here. Let's just say Hong Kong investor purchased large amount of, say, Bitcoin and Ethereum in Hong Kong to enjoy the arbitrage in connection with a much higher price in South Korea. So obviously the gain earning from the alienation of such a virtual asset becomes Korea source income for Hong Kong investors. Then we may want to look at which jurisdiction has taxing right over such income pursuant to the pertinent tax treaty. On to the next slide. Just for your information, as Michelle explained earlier in this session, the income derived from the alienation of the virtual asset, such as the Bitcoin, is classified as other income within the realm of Korean tax law. That being said, such income classification for domestic purposes doesn't necessarily mean it should also be applied to the interpretation and application of the tax treaty, and how such income will be classified for tax treaty purposes should be reviewed in the context of the tax treaty per se. So against this backdrop, let's take a look at the relevant article of the ROK Hong Kong tax treaty, especially capital gain and other income provision under the Article 13 and 20. So let's say such Korea source income were to be classified as capital gain first. If you see the capital gain provision here under the Korea Hong Kong Treaty, Article 13, especially paragraph 5, it says gain source in contracting party from the alienation of any property other than the referred to in paragraph 1 through 4 and derived by the resident of the other contracting party may be taxed in the first mentioned party, which seems that, in short, virtual asset service provider in Korea should withhold taxes on such Korea source income starting from January 2022 because source country has the taxing jurisdiction over the income. On the other hand, if such income were to be classified other income, just as domestic law says in Korea, only Hong Kong, which is the resident country of the Hong Kong investor, can claim the taxing jurisdiction over the such Korea. So basically, under these two provisions, there is a conflicting result as to who gets the taxing right on such income. So key issue here is whether virtual assets, such as Bitcoin, constitute a property in Korean legal system to be treated as a capital gain per tax treaty. And I'll delve into the details later on. So on the next page. So, and let's take a look. Another hypo here. Basically, the main difference is that the citizenship of the investor here, a Singaporean investor in this case. Onto the next page. Under this particular hypo, the situation is the opposite. Under the capital gain provision of the tax treaty, we may arguably interpret that Hong Kong has, the Singapore has the taxing jurisdiction over income. But on the other hand, under the other income provision of the treaty, especially paragraph 3 of the Article 20, the source country, which is South Korea in this case, may also have a taxing jurisdiction over such income. So therefore, it is likely that the Korean tax authority may want to interpret the income derived by a Singaporean investor as other income, whereas a Singaporean investor may want to argue it as a capital gain. So now it boils down to an issue whether virtual assets such as Bitcoin and Ethereum could constitute a property under the Korean legal classification. Next page. So this disputable point we found under the previous two hypos are summarized here. First of all, under the Korean tax law, other income is enumerated under the Korean income tax law, and Korean income tax law follows positive system, meaning only item enumerated under the law is acknowledged as other income, and everything else is not recognized as such. So second disputable point on this slide in application in application of tax treaty using the previous two hypo is whether virtual asset constitute a property in Korean legal system. For your information, pursuant to general definition of any tax treaties, any terms not defined therein should be interpreted in deference to the domestic law of the parties, especially the tax law. Next page. So let's take a look at how Korea sees the virtual asset. There are a couple of sources interpretation in Korea. First of all, Supreme Court ruling in 2018, criminal case, but in the ruling, virtual asset can be confiscated as a criminal proceed, meaning it was arguably acknowledged as property. The second is the KIFRS that Michelle briefly mentioned. It classified the inventory as it is held for sales in the ordinary course of the business activity. Otherwise, it is classified as an intangible asset. Third, special financial law enacted in March 2020, and it defines the cryptocurrency-related companies as the virtual asset managers, VASP. And the enactment of the law per se may be deemed as a government acknowledging as an asset of property. On the opposite view, however, there was a pushback from the Korean Financial Service Commission, FSC, in November 2020, and it stated publicly that the enactment of the law per se does not mean institutionalizing virtual asset, such as cryptocurrencies. Also, in April 2021, which is quite recent, Finance Minister reiterated that it is quite difficult to regard virtual cryptocurrencies as a financial asset like stocks and bonds. So the bottom line, the punchline on this slide is that the classification issue of the virtual asset from the legal perspective has just begun in Korea and will likely develop in the near future. Other Korean regulatory authorities may have a different view from financial service supervisory services announcement and the legal classification of the cryptocurrencies. So as a result, there is currently no law or clear guidance from any regulatory authority in Korea that provide the clarity on the legal classification of cryptocurrencies and how they will be treated under the Korean law. Next page. So given the uncertainty as to the legal treatment of the virtual asset in Korea, let's talk about the potential tax issue that might arise due to this unclarity. First of all, generally, Korean tax authorities have expressed reservation on providing rulings on tax treaty application issues, and this may not help the situation. Second of all, from the Korean virtual asset service providers' perspective, which are withholding agents in Korea, that it would be safer to withhold taxes conservatively in order not to be subject to any penalties and interest later on. So lastly, from Korean tax authorities' perspective, they may act strictly from the perspective of in pro fisco in dubio, meaning when in doubt for taxation, and they may cherry pick positions that may be favorable to them for a while. Next slide. Because of the issues just laid out, there could be a potential double taxation issues, and the root cause of the double taxation issue could arise due to the different interpretations and or the application of the pertinent tax treaty by respective taxing authorities. And in general, there are 3 potential measures for such a double taxation situation in Korea. I don't think this is that much different from other jurisdictions. First is to file amended return for already withheld taxes by the withholding agent. And then if rejected by the Korean tax authorities, go for a tax appeal process in Korea. And at the same time, we could file the MAP procedures as an alternate dispute resolution option. So my last slide. Let me wrap up my presentation by providing a key takeaway here. So first of all, other income could be construed differently per Korean income tax law and per tax treaties. And such Korean source income could be classified as either capital gain or other income in theory, depending on how you legally classify the virtual asset in Korea. And number 2, the legal classification of the virtual asset in Korea has yet to be crystallized, and stakeholders should closely keep abreast of the development in Korea in order to avoid any double taxation going forward. Number 3, once taxation of virtual asset begins in Korea, the foregoing uncertainty may lead to different interpretation and application of tax treaties, and a great deal of a tax dispute may arise until the clear regulation interpretation by the taxing authority or judicial decision comes out. Lastly, a few avenues available, such as the amended tax return, a tax appeal, and MAP procedures. So this is the end of my slide deck, and I hope all of you got some insight from the sessions. Over to you, Robert.
Yeah, thank you very much, Steve. I mean, that's very interesting to see, in an international context, just how the income from selling virtual assets could be taxed for non-residents in Korea, just depending on how that income is classified for treaty purposes. So thanks, Steve. So that completes our tour around Asia to see how other countries are taxing transactions involving virtual assets. In terms of wrapping up, I mean, the interesting thing for me is in just looking at this small handful of countries, it seems evident that countries are at very different stages of determining how virtual assets should be taxed, and the level of guidance varies between countries. And so as transactions involving virtual assets become more widespread and the technology continues to evolve, it will be important for countries, I think, for them to issue useful specific guidance regarding virtual assets to allow taxpayers to meet their compliance obligations and to allow also the virtual asset kind of ecosystem to continue to grow and develop. So I think this is certainly an area for us to continue to monitor. And with that, I'd just like to say a big thank you to all of our panel for taking the time to prepare for today's session and sharing their insights with us today. And thank you also to the audience for participating in today's session. So with that, thank you and goodbye.
Thank you, Mr. Burrell and panelists for the interesting discussions about virtual assets in APAC region. We think we're almost on time. Again, thank you all for participating online or offline in the first day of IFA APAC conference. We wish you enjoy the rest of your day and hopefully we'll meet again tomorrow. Thank you.